It's not about picking stocks. It's about picking the right portfolio.
Okay, this is from Ron Katz, and as he says, it's more of a statement than a question, but I thought kind of interesting to talk about. One of my clients with a $100 million business, which is gross sales, just went to renew their revolver, and their bank said 12% interest rate when the old rate was roughly 6%. How many times have you heard that? Line was $33 million, so approximately $2 million hit to cash flow. Maybe something that we're not talking about a lot, but when a lot of this, not just revolvers, but term debt has to renew, we're looking at a very, maybe more so term debt to some extent because it's longer term. We're looking at a very different interest rate scenario for a lot of these companies where, there really will be an impact on earnings and cash flow.
Yeah, it's underappreciated. It's a real problem, and I was listening to a podcast on my drive down here earlier this week, and they were going through some of the commercial real estate dynamics. And to give you an idea, if you think about, so you've got about $175 billion in office debt maturing this year, $150 billion next year. And if you think about the way those deals were set up, if you bought a building 3 or 4 years ago, and we're talking about some of the big metros like New York or San Francisco, and maybe not necessarily the AAA properties, but just about everything else, and you bought a building 3 or 4 years ago at a cap rate of 3, and your cost to fund that was close to 0, basically 3%, and you basically took down debt at a 60% LTV. Well, if that debt's coming up today for renewal, your effective LTV is around 100. And the problem with that is that obviously your debt's maturing, so you have to roll that over. And so there's this sort of game that is going on, will go on, and generally always goes on, which is kick the can. In financials, you call it extend and pretend, right? Extend the loan and pretend that everything's going to be okay. And that goes on really up until the debt itself matures. And then you get basically a catalytic event. And I think that's a pretty good way of thinking about how this is going to play out. So, you're going to have north of $1/3 $1 trillion maturing really over these next 18 months in the office space, which is sort of ground zero for everything. So I think that's going to be a problem.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.